One of the key moves in the markets recently has been a intense focus on the US 10-year bond yields, and it's been sending ripples down to equity markets. In this video, I'm going to explain to you why so much focus has been on that bond yield, what implication it's likely to have for equity markets going forward, and what impact it'll have on the dollar, and by implication, the impact across the major currency pairs. Please watch this video to get a real understanding of what's going on and what's driving these markets and what's likely to be trigger points coming up in the future. Well, as mentioned at the start of the video, bond yield rises have been an intense focus this week. And here's the rationale and the reason why. Now, the assumption has been going into the end of 2020 was that the US was going to recover much more slowly than the rest of the world. With low interest rates expected till 2023, high levels of quantitative easing, it was anticipated that the US dollar would remain weak into 2021. However, there has been a number of factors that are potentially changing that. We've had a huge stimulus package from the Democrat government in the US of $1.9 trillion set to be passed. And since that time, the US economy has been sort of gaining confidence from a huge stimulus support, and the market has been anticipating that actually the downturn in the US economy may not be as bad as has been feared. And that's why at the start of the year, we saw these bond yields starting to rise out above that 1% level and have moved up recently into that 1.5% level. Now, last week, around Thursday or Friday, the US 10-year yields hit through that 1.487 level, which was the same level as the dividends for the S&P 500. And it was seen as a kind of line in the sand that the bond yields had crossed, and that the market was anticipating a faster than expected US economic recovery, and that crucially interest rates would be rising sooner than 2023. So the question is the Federal Reserve behind the market's expectations for the projection of the US economy? That has been what's been driving this strong rise in yields. Now, this strong rise in yields was also resulting in some equity selling. Now, yields and equities can rise together quite happily, but you can see here, as illustrated in the S&P 500, the problem is if it's too fast, too quickly, that's what equity investors have been fearing. And you can see here from last Friday, a sharp sell-off in the S&P 500, and you see that the sell-off has carried on during this week. We can see that this crucial trend line down from March 2020 all the way up through the lows on October 2020, February 2021, and that has broken to the downside. So there's a key technical break in the equity markets, and it's all to do with the speed of the bond yield rises. Now, yesterday was an absolutely crucial day because Jerome Powell had an opportunity to address these rises in the bond yields. And various other central banks had mentioned it. So the Reserve Bank of Australia had brought forward their asset purchases. They'd accelerated the purchases to try to deal with Australian government bonds rising. You can see here as they've tried to deal with those rising 10-year yields, so a little dip lower. We've also had the RBNZ mentioning that they're prepared to potentially increase their QE packages to contain New Zealand's bond yield rises. The ECB this week was sort of saying, well, we're not too concerned about the rising bond yields, and that set an important precedent. The risk was that Jerome Powell would say, yeah, well, I'm not concerned about these rising bond yields either. Yesterday, he essentially said that. He said that, yes, he's concerned about disorderly conditions in the financial markets, but he said the 10-year yields, yield rises are only one factor of a number of factors that I'm looking at. So that gave the market permission to keep on pushing bond yields higher. And where will it be considered too high? 1.6, 1.7, 1.8, 1.9. The expectation now is that bond yields can rise. Now, economic data out of the US is going to be key. And that's going to be key for the path of both equities and the US dollar. So here's the things to look for. If we see sharp rocket-like rises in yields, expect that to keep weighing on equities. If we start to see those bond yield rises slow down or move sideways, equities can recover. Secondly, if economic data is very good, so we've got non-farm payrolls out shortly today, and if those non-farm payrolls show a really good reading, remember labour data is a key focus for the Federal Reserve, then we'd expect to see the 10-year yields rise even further, and that would send the dollar index even higher. So the key things to be looking at is the economic data coming out of the US. Now, you can see here the dollar index just keeps making higher highs. After that, Jerome Powell yesterday, we saw strength in the dollar, and that's continued abated. And the next stop is this key trend line around the 92.50-93 region. So stronger than expected NFP data, and we can look at testing that trend line. If we get above that trend line, you'll see how crucial that is in the dollar index. That opens up back into that 94-95 region. You see this long trend line here. If we get back into that trend line, break above, then we're back up to 95, potentially 96 overhead. So that's what we're looking at. It's very significant. Now, equity markets, just want to say, equity markets do normally have some kind of pullback. So you can see here, this is, even when you get full year returns, you know, in the green bars here, you get intra-year declines. So pullbacks in bull markets is just normal. So we are expecting equity markets to still remain supported. We have low accommodative policy from central banks, fiscal stimulus, all of this should be supportive for equity markets in the medium term. So dips would expect to be bought in equity markets. And secondly, looking at the dollar, we can see that the dollar has very, very accented short positions. So if we do see stronger than expected NFP data, if we see a more swifter recovery being demonstrated out of the data of the US, then we expect some of these short hedge-funded selling US dollar positions to reverse. And you can see in the COT report here that the US dollar is the largest net short position. Now, if all of a sudden the economic conditions can change, all these short traders are going to be getting out of their shorts. Some of them may be initiating longs, and we're going to see these shorts unwind. And as they unwind, it's going to further spring prices higher, you see. So there's a real risk here that the dollar is about to undergo a medium-term shift trend change, at least in the medium term. Get above this, and then we're looking at sort of 94, 95 as the first test. Hope that helps to understand what's going on with the dollar, how that will impact equity markets, and what to look for going forward. If you like this video, please give it a thumbs up, like and share it. It's very helpful for me to know both what's helpful and also the more you like and share videos, the more time I can commit to making sure I get the great and the right content that people want. Secondly, you can follow me on Twitter at Giles Coghlan CCCA. That's my Twitter handle. And you can also link up with me on LinkedIn, as well as sending me a direct email here at giles.coghlan@hycm.com. Don't forget my HYCM blog. I put lots of really good information up on that blog. Just link up with me there. And you can also contact me direct for some great programs I've set up to help traders take their trading to the next level. I'm passionate helping traders to get there, to break through that profitability barrier. And they are skills. Trading is just a skill that can be learned like any profession. And I put a lot of time and effort to try to put the right tools in place for traders. So contact me there, as well as, don't forget, live market analysis. Each week, you can register for that on the website. Go to the blog there. You can register for the live market analysis week ahead webinar I do, as well as a workshop I do for HYCM clients on Wednesday. It would be great to link up with you. I'll just quickly show you the Twitter post. So this is my Twitter page. Here's my Twitter handle. You can link up with me here with LinkedIn, and also you can also access the trading programs here. There may be a link underneath. If there isn't a trading link underneath this video, please do contact me and I can send you a link personally. But this just shows you the tools I've set up for people to make a deposit to HYCM. So there's no cost to you for these programs aside from making a deposit. So they really are excellent value, and really do give people an excellent opportunity to take their trading to the next level.